We're going to continue discussing what I look for when I trade. And I've got a great setup for you on Dish Network. Stick around. Hi, this is Tim from TradingStrategyGuides.com. Today I'll be continuing with the training on what to look for to find these setups. I appreciate all your comments. I expect to wrap up the pattern recognition stuff next week, so we'll move on to other list items after that. Also, I think someone might be filling in for me while I'm at my nephew's wedding in Indiana next month. I'll keep you posted on any changes that may happen. Okay, I know I sort of showed you a setup on Dish Network last week as part of the training video. I didn't actually enter that trade. You're good if you did enter it, but I've got a new setup on it this week that I like much better than the pattern I showed you last week. I'll get into that shortly. First, I want to take a look at our open trades and the new setup, and then we'll get into the pattern recognition training. Remember, you can speed this video up by clicking the gear icon in the lower right of the video and selecting a new speed. Let's have a look at the open trades. I mentioned in Monday's video that I sold Amazon right here. I'm still in it. I still like it. Let's see what it does. Still not too late to get into it, or if you prefer, you can wait until it breaks this level right here. Whatever makes you happy. Well, Johnson & Johnson looked really good, then it didn't. It popped up yesterday right here for one of those rare occurrences of full stop. I think it's only maybe the fourth or fifth full stop I've taken since I've been doing these videos. So I'm done with JNJ for right now. On that note, I want to share the trade spreadsheet with you. I don't pull this up every week, but I do keep track of it. I dare say you won't see many traders calling trades in advance and then showing you their results. Oh, I know there are some out there. I've worked with some of them, but I do it, and I keep close track on this. It represents a fictitious $100,000 account. I started with $100,000 right up here, and I have entered every single trade that I have done a video on, barring any errors, of course. And I enter all the trades, including the ones that are in my videos or on my Twitter account. The green lines are winners, the light pink ones are small losers, and the dark pink ones are full stops. White and yellow are open trades. You can see at one point we were up 32% right there. Now our profit is currently a little over 24%. Because we're going through a little bit of a drawdown. You can see we got 5 losers right there in a row. You know, that happens once in a while. I'm sharing this with you for a reason. I want you to understand that drawdowns are part of the game. You can't get down and out about it. You have to know that it happens sometimes. And I'm perfectly fine with this. Nothing in the market is 100% sure. And we control our risk on each trade so that no single trade will make or break us. Also, I have confidence in my strategy because I've thoroughly back-tested and forward-tested it. I know the strategy works, but I also know that drawdowns happen. I'm not going to stop trading just because I've got this drawdown. I will continue taking these trades just as I always have been, and you know, it's only going to take 1 or 2 of the big winners to get back up and well beyond our prior 32% number. Okay, I've got a couple of more charts to look at, and then we'll talk about Dish. Papa John's Pizza has closed way above the descending triangle here, so this is no trade. The setup is blown, and I'm done with Papa John's for right now. Of course, this wasn't a loss because there was no entry. I would have had to get a close down here somewhere to make an entry. I'm actually recording this video on Tuesday night, and I entered this right here, the E-mini Russell 2000, on this close below the range. I haven't had an opportunity to put the numbers and the lines on the chart, but my entry was 1454.8 with a stop loss of 1503.7 and a first target of 1422.2. Obviously, right now it's not too late to get into this. As long as it hasn't dropped down much below the 1454.8 level, you should be good to get into this. Of course, if this closes back into the range, then we'll close the trade and take the loss right then. Okay, let's talk about Dish Network. I'm sure almost everyone in the U.S. already knows about Dish Network Corporation. Dish is a U.S. television provider based in Meridian, Colorado. They own the direct broadcast satellite provider known as Dish and the IP television service known as Sling TV. And you know what? I had no idea until I was doing the research for this that Dish actually stands for Digital Sky Highway. I've been a Dish customer for, at least 20 years. So that's kind of strange, isn't it? So anyway, you learn something new every day, right? So apparently Dish is having a real problem competing with internet streaming television services like Netflix and Amazon, and it's been hurting them in the pocketbook just a bit. But as you know, I think the chart is the ultimate arbiter of the market because everything that can be known about a market is built into the price. So let's take a look at the chart. Okay, this is the pattern that I looked at last week in the training. This continuation triangle. I didn't like it too much. It was too small, and I think I mentioned that in the video. I did go ahead and take the Amazon pattern, but I just like that one a little bit better. But in this case, if you did take this on this close right here, I think you're still good. This is beyond the pattern now, so you're not going to get a close back in the pattern. But if you get a close up above this triangle, I think I would be out of it. With that said, let me show you a pattern I like a lot better on it. Okay, with this push down right here a couple of days ago, we got a really nice looking trading range between 30.82, 32.92. I like it because it's a much larger pattern and it's nicely supported here by the declining volume and the declining volatility. Now again, I've had people ask me about how you see this declining volume and volatility. The volatility is a little more obvious because it's just a line down. They're not going to be perfect. There's always going to be humps and bumps, and sometimes they'll hump and bump up here and stuff. But what you're looking for on the volatility is lower highs, lower lows. Okay? The same here on the volume bars and on the volume average. Now the volume average, of course, is 20 periods behind the volume bars themselves. But you can see you got lower highs on the volume bars, lower lows on the volume bars here, and then eventually the volume average catches up with the decline. So you're looking for an overall look right here. You can't look at individual ones and say, well, this one is lower than this one right here, so that's not a decline. Well, you can't look at the market in that way. You have to think of the market in terms of trend direction. And a trend is just defined as lower lows and lower highs, or higher lows and higher highs for an uptrend. So if you want to find declining volume, you want to see lower lows and lower highs. Same with the volatility. And like I say, remember that these volume bars represent the volume for that day, but this average and this average right here represents 2 or 3 weeks past information. So this is lagging a couple of weeks. So here's the trade plan on Dish Network. We will buy a close above the range or above 32.92, or we will sell a close below the range or below 30.82. I had a question about whether I would reverse the trade if it dropped down below here and then went back up and popped above it. I don't like to do that. That's just too arbitrary to me. I've identified this trading range and I am looking for a momentum break out of this trading range. So once it's made its momentum break down here, then in my opinion the pattern is done. Okay, so I don't look for it to then break the top. I know a lot of traders will take the break down here and they'll put their stop above the range, and if it breaks above they'll turn, and so on and so forth. I just don't like that. That's just not me. If that works for you, that's great. I'm not being critical of doing that. I'm just saying that I personally don't like to do that. Okay, on the breaking candle, to enter a full-size position, I want to see this volume bar reach the average, okay, or beyond. If it doesn't quite reach the average, but it does reach 75% of the average, then I'll open a half-size position to reduce risk. And to calculate that 75%, take this volume number right here on the breaking candle, divide it by this volume average, and the calculator should give you 0.75. If you don't get at least 0.75, don't enter the trade. The stop loss will be 1.5 times the ATR, and the first target will be 1 times the ATR. So on the breaking candle, look over here and get the ATR, multiply it by 1.5, and then place your stop loss order that far behind the entry price. So measure from the entry price back to enter your stop loss. Place your first take profit 1 ATR ahead of the entry price. Okay, so the location of your stop and your take profit is based on the entry price, not the range itself. If after entering the trade we get a candle that closes back inside the range, up in here or in here somewhere, we will take the loss right then and not wait for it to hit the stop loss. Our intention is that a breakout from these patterns should be explosive and hit our target fairly quickly. If the momentum goes away, we want to shut the trade down as quickly as possible without taking a full stop. When the price hits our first target, we will close half the position for profit and set the stop loss to break even on the remainder. We will then follow the stops as price moves in our direction until the market takes us out. Now, mechanically, the way I do this, typically I use 2 positions. The first position has the hard stop loss on it and a hard take profit at the appropriate price. The second position will have a hard stop loss on it, but I will have no take profit directly associated with the second position, and then I'll follow stops behind it. And that's the Dish Network setup. So let's talk some more about pattern recognition. I've showed you this slide before. These are most of the patterns that I look for. The only one that's missing from here is the trading range, and we're going to talk about trading ranges next week. Last week we talked about continuation triangles, and this week we're going to talk about bull flags and bear flags. Just like all consolidations that we look at, what you're witnessing is a knife fight. Traders that want price to go up, otherwise known as bulls, are fighting with traders that want price to go down, otherwise known as bears. So the bulls and the bears are having a knife fight here, and price goes back and forth, and typically a tight wind-up consolidation. Sometimes they don't wind up though, and we end up with a bull flag or a bear flag. As with continuation triangles, we need an incoming trend to act as a flagpole. I like to say that a bull flag needs some bull to get started. Then the flag is a parallel channel that pulls back against the trend. These flags can actually pull back quite a ways. Let's take a look at an actual bull flag on a chart. You may recognize this chart right here. It's a daily chart of the Australian dollar, New Zealand dollar, and we just finished up this trade right here when this price pulled down and hit the stop loss that I had up in that area right there. It was a profitable trade, but I was hoping for a little bit more of a move, and it looks like it might be continuing on without us. But that happens sometimes, right? This has been in a bull flag for quite a while, since mid-April or so, right in here, and then it finally broke out in early August. We got into this trade, and it pulled back to 100% of the prior incoming trend. So don't be surprised if bull flags, bear flags can pull back to 100% retracement. Remember, these patterns are rarely perfect. In fact, I believe I recall taking a trade on this bar right here, if I'm not mistaken. I didn't look back to confirm it, but I think I took it on that, and I closed it when the candle closed back inside the bull flag. I closed the trade and I redrew the bull flag. Sometimes you just have to do that, redraw it, and continue to watch it. As with all patterns, you should look for a decline in the volatility and a decline in the volume. You can see this was not a huge decline. In fact, it pulled up just a little bit right in here, but right near the end, just before it broke out, we got a decline and a kind of a funky little decline in the volatility right here. I prefer to have a decline in the volume and the volatility during the course of these patterns, but it's not a strict requirement. I'm still studying whether I will change my rules to make it a strict requirement, but that's kind of a story for another day. Anyway, we expect a flag to break in the direction of the incoming trend. So here's the incoming trend, and the break went to the upside. I will not take a break in the opposite direction, so I would not have taken a break in this direction. Also, if there isn't sufficient volume on the close above the bull flag, I'll stand aside for that as well. As I've said just about every time, I want to see the volume bar reach the average for a full-size position, or at least 75% of the average for a half-size position. Like I said last week, this is standard operating procedure on all consolidations, and you'll hear me repeat that on each setup to remind you. Now, of course, the bear flag is just the flip of the bull flag. So you'll look for a downtrend in with a nice pullback in the form of a parallel channel. And here's an example on a live chart. This is a daily chart of the Australian dollar Swiss franc. This is a pretty nice example of a bear flag. Incoming trend right here. Pullback in the parallel channel. The trade would have been right here on the close below the channel. This didn't quite make the target right here, but this did not hit the stop. It never closed back inside the bear flag, and then it did come down and hit the target right in here. So this then, of course, would have stopped out the second half break even, but you'll notice we did have nice declining volume and declining volatility on this setup. Okay, I told you last week I want you to pore over hundreds of charts looking for these patterns, okay? Look for bull flags, bear flags on all time frames on all markets. These patterns happen frequently, particularly on Forex. I find this pattern on Forex more than anything else. Just remember that they're rarely going to be perfect. After you've looked at a bunch of charts, these patterns will start jumping out at you and you'll see them everywhere. And that brings me to today's maxim. Again, I'm going to draw from the archives, but it's one you've heard lots of times because I repeat it almost every day. A maxim is a general truth, fundamental principle, rule of conduct, or a proverbial saying. These maxims come from various sources, the books, the internet, coaches, teachers, others. The purpose of my maxims is to motivate me to discipline in trading, in life, whatever. I suggest you start your own list of maxims to help in your trading. They need to be things you can say to yourself while you're trading to make sure that you do the right thing every single time. Feel free to borrow from my list. And today's maxim, Tim's Trading Maxim number 11, don't practice until you get it right, practice until you can't get it wrong. You may have heard this last week. Because what you need to do is practice, practice, practice. I've been a musician for most of my life. And as a kid, somewhere along the line, one of my teachers told me this. It stuck with me all this time, 50, 55 years or so. And it may have been my dad that told me that. He was one of my teachers for a while. So I think about this every time I think about practicing. And this applies to everything. We've heard that practice makes perfect, and I always thought that I would just practice something until I get it right. But you know what? I'd invariably get it wrong the very next time I tried it. So I kept practicing and practicing until I never messed it up. Of course, I'm not perfect at anything I do, so I do mess things up periodically. And I usually come clean on the channel when I mess up here about one of my trades, but I try to get it right every time. And if you want to be able to spot these patterns in the charts on your own, you're going to have to practice, just like you did when you were 11 and taking piano lessons, or 14 and playing on the football team, or 16 and on the cheerleading team. Whatever you did, you practiced and you practiced and you practiced until you couldn't get it wrong. And don't forget the Dish Network trade plan. We're looking for a daily candle close above 32.92 to buy, or a daily candle close below 30.82 to sell. If the volume is not quite average, go half size as long as it's at least 75% of the average. Your stop loss is 1.5 times the ATR, and your first target is 1 times the ATR. And remember, you can check out my trade management video for more details about this. The link will be below the video. And look what Casey set up for me. Tim Black's Trading Picks. He even put my picture up there. I'm sorry if it breaks your screen. Go sign up for my Trading Picks email list, just so you don't miss any of these. I mean, we're making some money at this. I'll be sending out about 3 or 4 trading picks a week. Everything from stocks to futures to cryptos to Forex, and you'll get to see them first. Plus, you'll get first notifications of anything else special that's happening. And the best thing, it's free. I'll put the link below the video. And be sure to come back to Trading Strategy Guide's YouTube channel every week on Monday and Friday for my analysis videos, and on Wednesday morning for training videos just like this one, which will most likely include a trade setup like today. Thanks for all the input I'm getting on the training ideas. Continue to let me know what things are bugging you about your trading or about my trading. I'll be glad to explain anything you guys want me to explain. And you know what? If you don't like what I do, tell me about it. That's fine. I don't mind. It doesn't, I'm not going to hate you or anything. People tell me I'm ugly all the time. I'm used to it. I'm fine with it. Just let me know what you're thinking. And remember, the only stupid question is one that hasn't been asked. Okay? So if you don't understand something, let me explain it to you. I can't explain it to you if I don't know that it's a problem. Also, follow me on Twitter. My Twitter link is below. Tell your friends about us and help us make this the best trading channel on the internet. As always, thanks for watching, thanks for subscribing, and don't forget to hit the thumbs up below. Have a great remainder of your week, and I'll see you next time.